Good afternoon, everyone, and welcome to this next session in the Kepler Trust Intelligence event, focusing on trusts which are on interesting discounts. We will shortly be hearing from Oliver Gardey and Colm Walsh of the management team of ICG Enterprise Trust. ICG Enterprise invests in profitable cash-generative private companies in Europe and the US, both directly and through other third-party managers. It has quarterly results coming up in a few days. I would note that the discount is currently 14.3% as of yesterday's close, and that if past patterns were to repeat, that may widen as the market tends to be late in recognizing good news. So if there's any good news to come, then this could prove an interesting time to be investing. So before I hand over, just a reminder that if you'd like to put a question to the manager, please use the Q&A box to the right. I will collate those as we go through. You're all on mute for the duration. We have 20 to 30 minutes of the presentation, and then we should be able to get through all your questions. So please do put those in the box to the right. So with that, I'll hand over to Oliver and Colm.
Thank you, Thomas. Hello, everybody. It's a pleasure to present to you today and to be part of the Kepler's Discount Conference. I'm excited about it for two reasons. One is to present something I'm very passionate about, and to hopefully be able, that Colm and I will be able to kind of show you why we think this is a great value proposition, the ICG Enterprise Trust. And second, that we've been identified also by Kepler that that we are a great value proposition. So it's not just Colm and me trying to tell you something. So we're very excited that we can participate in this conference and make our case why the ICGT is a great value proposition. But before we go into that, I'd like to introduce myself quickly, and Colm will introduce himself. I've been working in the private equity industry for over 25 years in all aspects of the private equity industry, from doing my own buyout and running a business, turning it around and selling it, as well as running a direct private equity funds, as well as building secondaries and making funds investments, which all those capabilities and expertise comes together in Enterprise Trust, because we do all those three things. We invest in funds, we invest directly in companies, and we are also doing secondaries. I look after, I'm the manager of the ICG Enterprise Trust, and Colm is my partner. I will pass on to Colm to introduce himself.
Hello, everybody, and thanks very much for your time today. My name's Colm Walsh. I'm a managing director in the private equity funds investment group at ICG, and I spent 15 years of my career working in private equity. Started off working for a pan-European PE fund, and then 11 years ago I started working on what was then Graphite Enterprise Trust, and which has subsequently become ICG Enterprise Trust. I spent most of the last 5 years since we joined ICG building up our US investment program. So with that, enough about us. I'm going to pass back to Oliver, who's going to give you a bit of an introduction to ICG Enterprise Trust.
Yeah, so what we're going to do in terms of as an agenda, we're going to introduce you first to ICG Enterprise Trust, so that you get to feel for what we're talking about, and then Colm will specifically talk about private equity as an asset class. What are the pros and cons, and why private equity is an attractive asset class, and then I'll conclude with highlighting the value proposition. And with that, maybe a quick introduction to ICG Enterprise Trust, which is the oldest listed private equity investment trust. It was founded in 1981, and having been around now for 40 years, that obviously tells you that we have a lot of experience, and we've learned a lot along this journey, and we have a proven and sustainable investment model. Our mantra is really, at the end of the day, is to democratize private equity, which means what we are trying to provide access is to everybody, to all shareholders. Private equity, as you probably know, has been in the past very much only was really only access for the privileged few, and because you have to put a lot of capital to work in order to diversify your portfolio, or even getting access and entry to the best fund managers and the top tier funds. And so what we're doing is we're really are able, with our portfolio, with our top tier fund managers through the trust vehicle, to provide everybody who is willing to pay 12p a share to get access to private equity. We've had and enjoyed 12 consecutive years of double-digit growth. How we do this, Colm will explain and introduce you to. And then I think another unique feature for the ICG Enterprise Trust was that we came on the platform onto the ICG platform about 5 years ago, and that really allowed us to get to another level in terms of insight in the industry, institutionalizing our operations, and that was really a great opportunity for us to really grow and scale, which was already a very attractive investment strategy, and institutionalize the business even further. And I'm pleased to say that we are now a FTSE 250 business. And with that, I hand you over to Colm to start with the next slide. Oops, that went the wrong way. Here we go.
Thanks, Oliver. This slide's a particularly important one, we think, because it summarizes our focused investment strategy. I think if there's one thing I'd like you to take away from this, it's just that we are very, very focused. And we're very, very focused on an investment strategy which we believe delivers the optimal balance between risk and return. And very simplistically, when you look at this chart, we view our focus on buyouts, and that's to say predominantly mature, cash-generative companies where the manager we invest alongside is a control position, typically in very established markets, as being the best way that we manage our risk. Because what we don't do is invest in strategies like growth equity or venture capital. So things like venture capital, they can generate headline-grabbing returns, and we've all seen them in the financial press. But in order to generate a sound overall return, there is a reliance on generating these big winners. And the loss rates can be really high, so often in excess of 50%. And in our view, focusing on buyouts, which have lower loss rates and a much greater consistency, offers the best risk-adjusted return profile. When you look at this chart and you see the blue areas, we like to think of these as the areas where we optimize returns through our selectivity. We focus only on developed markets, principally the US and Europe. These are the markets that quite simply have the most experience, the best performing, and above all else, the best resourced managers. And we focus on the larger deal sizes alongside very established top tier managers. We like these managers. We like managers with experience of managing through cycles, and we think that they're best equipped to execute the private equity ownership model, which I'm going to discuss later. They have greater resources, greater sectoral expertise, and really sound institutional experience. And finally, within this universe, we're really focused on identifying fund managers, fund strategies, and underlying deals which offer what we term defensive growth. And in very simple terms, that's companies which have growth drivers, is perhaps in areas like healthcare, like technology, where there's very significant secular growth. And that means that their performance, the underlying company performance, is significantly less sensitive to economic fluctuations. So moving on now to the next slide, slide 5. And this shows you the portfolio that's been constructed through executing this strategy. Just a few things to pick up here. You can see that it's very balanced between North America and Europe. As I was saying earlier, the world's two largest, two deepest private equity markets, and also the markets, as I said, which we think have the best managers. We've constructed the portfolio so that the top 30 deals, and this is typically through co-investing alongside our managers and their best ideas, constitute just over half of the total portfolio value. And the top 10 companies, whose logos you can see on the slide, are about 1/3 of the total value. you can see from our sector exposure chart here that we've got relatively high weightings compared to public markets in pretty resilient sectors. So things like healthcare, education, technology. But it's worth noting too that much of the exposure that we have in seemingly less defensive sectors, so for example, consumer, because of our approach to portfolio construction, many of the companies are companies that we've hand selected, and they're in very defensive niches. And actually, you can see some of these larger consumer companies in our top 10 investments. So just to pick up a few examples, our largest exposure is to PetSmart Chewy. It's America's largest specialty pet food retailer, combination of a physical and an e-commerce business. Obviously, that has performed tremendously well through the recent COVID pandemic, because you have secular trends of increased pet ownership, but you've also got increased market share for e-commerce businesses. We've Leaf Home Solutions, which has grown dramatically over the last 5 years. It's a company which focuses on the home improvement space in the US. And Fronieri, a company which most of you won't have heard of Fronieri per se, but it's one of the world's largest manufacturers of ice cream. And if your household is anything like the Walsh household, you probably have quite a few of their products hidden away in the freezer. Just to pick up a few of the other top 10 companies you can see here, just to bring out a bit more about defensive growth. A really good example is something like Minimax. It's not exactly a household name unless you happen to be a fire protection expert, but it's a global leader in that space. It's a manufacturer and a service provider for fire protection components. And I really like this as an example of what we mean when we talk about defensive growth. This business, its underlying demand for its services and its products are driven by regulation and increasing focus on safety. And I mentioned the services component. That means that it's got a very solid recurring revenue base. So it's a really, really good example of what we mean when we talk about defensive growth. So I'd like to move on now to slide 6. So I've told you a little bit about what we do at ICG Enterprise, but I thought it's probably worth spending a little bit of time on the merits of private equity as an asset class. And I suppose we can make this very complicated, but the most obvious one, which you can see very clearly from the chart, is performance. And the chart shows annualized returns over the last 5 years. And you can see the private equities delivered in excess of 15%, significantly ahead of the other asset classes which we cited. It's also worth noting that when you invest in private equity, you get a very different sectoral mix to what you get when you invest typically in public markets. As you saw in the previous slide, we looked at our portfolio there, and this is reflected in the broader private equity market. Private equity tends to have higher weightings to high growth, resilient sectors in contrast to public markets, so particularly in the UK, where the FTSE is very highly weighted to large financial services companies, oil, natural resources. And you can see too that it's a growing asset class. It manages as an industry $6 trillion globally. That's tripled in size over the last 10 years. But one thing I would like to emphasize is there's still plenty of runway for private equity to grow. I mean, private equity still has less assets under management as an industry than either of the world's largest asset managers. The industry has fewer assets than Vanguard or BlackRock under management. 6 trillion is equivalent to the combined market caps of just 3 S&P 500 companies. So private equity has grown significantly in the last 10 years, but there's plenty of scope for it to increase its share. And the strength of the asset class is really validated by the actions of some of the world's most sophisticated investors. So unlike private investors, not constrained by resources, not constrained by liquidity requirements or access requirements. And many of the world's leading pension schemes, many of the world's leading sovereign wealth funds, those that disclose it, have significantly increased their allocations to private equity over the last 5 years. Moving now on to slide 7, and I'd just like to spend a little bit of time before I pass back to Oliver, focusing on what drives some of the outperformance that we've seen. And we believe that one of the key differentiating factors for private equity as an asset class is the strength of the private equity model. And in particular, it's a very active model. PE managers engage and challenge portfolio companies, their management teams, to drive strategic change. They typically employ professionals, operational professionals, but they have all sorts of other specialist staff who work with their portfolio companies to help them grow. In contrast to, perhaps in some cases, to public companies, we think that the interests are particularly well aligned in private equity between all of the stakeholders, and in particular between company management teams and investors. Again, just very much focused on driving growth, development, and therefore investment returns generated by those companies. There's a very long-term time horizon with private equity. Private equity managers typically don't have to meet quarterly earnings expectations. They're able to take long-term investment decisions. They're not distracted by short-term noise performance targets. You can also see that very long-term approach is also evident in the way in which private equity identifies investment opportunities. PE managers are very focused, very thematic. They spend years getting to know very, very specific niche subsectors. And that leaves them very well placed to identify the most attractive investment opportunities. And often they're identifying the opportunities long in advance of sales processes. It's a very sort of slow burner before the right investments come along. It's very thoughtful, very research-based. It's not reactive to opportunities. It's very forward-thinking. So we think that all of these factors, and obviously it's significantly more complex, but I just wanted to give you a flavor of how we thought about it, makes for a very compelling investment proposition. Proven strong performance, a really strong and again proven model for value creation, and you see that in the support of the world's leading institutional investors. And yet, as we're going to go on to discuss in a second, we see many listed private equity vehicles, including ICG Enterprise, trading on what can seem like quite persistent discounts. So I'm going to pass back to Oliver just to explore that a bit more. He's just going to spend some time discussing that phenomena, and in the context of how the model works and how we at ICG Enterprise construct our portfolio. He's going to dive a little bit more into our own value proposition.
Yeah, thanks, Colm. So really, what we're here for is to talk about why is ICGT an attractive value proposition, and it's really driven by three parts. One is I'm going to talk about the anomalous discount of the sector given the performance, and then the consistent shareholder value creation and what our returns look like from a risk perspective and from volatility perspective. And lastly, how do we get our arms around and how do we get a hand around of what's the embedded value like within our portfolio? And so let's talk about the discount in the next slide. This is an incredible feature of the listed private equity sector, and here I'm talking about the overall sector, not just about ICGT. And it's incredible when you look at the right-hand side how much the sector has outperformed the FTSE All-Share Index, and as well as many other public sectors indexes. And so you see here that we have managed to more than double over the last 5 years as an industry as a whole. It's mainly really 4 to 6 players in the listed private equity trust sector here in England, which is really the biggest market for those listed trusts. And when you look at this chart, you would think about, okay, I really want to own this asset. I mean, the growth is very consistent, very strong. So therefore, you should actually, at least it should be trading at an NAV, at par, or even at a premium, because this is a very attractive sector to hold in your portfolio. But interestingly, if you look at the left-hand side, the actual historical discount to NAV is trading at 20 to 10%, and there are periods where it's trading actually substantially below that. And so what's going on, and why is there such a anomalous discount here? And the other interesting point is when you look at this, when you look at what happened in April 2020 during the COVID period, where you saw the listed trust sector drop to about 50% discount to NAV, mimicking very much kind of what's happened in the all share index. But when you look at on the right hand chart, if you look at the actual NAV and the actual portfolio value of the embedded value in the portfolio, it really didn't do much. It really was pretty much flat, even slightly growing during the April 2020 to October 2020 phase. And that is just I find that astonishing, and investors just didn't see it and didn't trust that the private equity sector can continue to perform and is sound and resilient, and has in their portfolios lots of good companies which are growing nicely. And so therefore the market reacted very strongly, and we were as a sector trading at a 50% discount. So why is this? And does this make sense? And when you think about it from an economic perspective or from a financial theory, it doesn't really make sense. However, I think it does make sense when you think about it from from our behavior perspective, and when you look at the memories from the GFC. So Billy from Kepler wrote actually in November 2019 a really good note, which I think describes this anomalous discount really well. What's happening here is what he wrote, and what I believe is still what is happening here. There are just strong memories of the GFC when a couple listed private equity trusts didn't survive the GFC, and went belly up and went into some real difficulties. And I think that's what the market reacted to. They said, oh, we have a financial crisis, we have a recession, we have a COVID inflicted, and therefore this is going to impact the listed trust sector. But not really. I think what the market is not understanding is that today the listed trust sectors are the survivors of the GFC and are fundamentally in a very sound position. The listed private equity trusts who did not survive the GFC were all more or less leveraged vehicles, versus the current sector doesn't use leverage in their vehicles. To the contrary, they have actually very sound balance sheets because they have actually revolving funding facilities. So if they do get into a liquidity squeeze, they can actually pull on revolver lines and manage through that liquidity hole. And so, therefore, I believe very strongly that this anomalous discount you see here is really bad memories from the GFC, and is not really applicable to what you see actually what's happening in the NAV of the underlying portfolios, as you see on the right hand chart. So then you ask yourself, what is the industry going to do about it? And are we always going to have these bad memories, and are we going to change it? Is it ever going to change? And this is something which we as an industry, and Colm and I, are very committed to, is creating the awareness in the market that the listed trust sector is in really good shape, has very strong balance sheets, strong liquidity, and take some of that fear and that irrational behavior out of the market. And we as an industry have not done good enough a job to educate the market what the real value proposition is and how sound and safe the actual sector is. And now let's go on to the next slide. This is now more ICG oriented. So what I talked about before is where we see the value proposition in the sector as a whole. And here's what I want to talk about and show you that we have an investment strategy which really creates consistent shareholder value. And when you look at the overall numbers here, I think they're impressive on its own, with a 15.8% 5-year analyzed NAV per share return on a year-on-year basis. And we've had now last year, our last fiscal year was the 12th consecutive year we had any double-digit NAV growth, and we are on plan and on target to have the 13th consecutive year of double-digit growth. So those numbers in terms of the returns are, I think, quite impressive on the standalone basis. But I think what we're particularly proud of is when you look at it from a risk return perspective and from a volatility perspective. So when you look at these dots, this chart on the upper chart, you see the NAV per share growth in the shaded area, which looks like a mountain range. And then you see the little dots next to it. All those dots represent the actual growth we had in NAV for that quarter. And then you see in the 5 years, there were only 2 quarters where we were down. And one was COVID driven, where we were down only 4% for the quarter, and then picked it up quickly back up again, as you saw. And the other one was about 2% where we were down in October 2019 because of an extreme foreign currency swing. But other than that, we've been 5 years, every quarter up, and on average, typically you can expect a 2 to 4% growth. And then when we have particularly good exits or realizations, you see some outliers between 8 to 12 times returns. But you see that consistency is ticking very nicely at about 2 to 4% per quarter. And then now, how does this compare to our peers? So you see on the bottom hand, Colm explained to us what our investment strategy is, and in the second slide, he talked about risk-adjusted returns, and that's what we're all about. Is we're really trying to take the risk out of the private equity class and emphasize the return by our strategy by investing in defensive growth companies and in top-tier fund managers, and that's what but still have a diversified portfolio and be able to pick the best ideas from our top-tier private equity managers. And that investment strategy, as you see here, has worked quite well. So our volatility is, compared to some competitors, significantly below our competitors. And that is something which we're particularly proud of because it just shows that our investment strategy is working. The last value proposition is really thinking about what is the actual what is our embedded value in our portfolio like, and trying to get your head around on private equity, how good is actually the NAV in the portfolio is a difficult exercise, as you all can appreciate. These are private companies. There's, compared to the listed market, they're usually small to mid-cap companies. But the most assuring benchmark and the measure I like to use, and which is my preferred one, is to look at actually the realizations and the uplift at realizations. What is that? That means these are the actual, what you see here on the slide is the actual uplift we've achieved by selling a company over the actual holding value in the portfolio at that point in time. And so you see here that over the last 5 years, we've generated above 25% on average, 38% and above uplift to realizations, which tells you that we hold our portfolio fairly conservatively, and there is significant embedded value within our portfolio. Now, I'd like to conclude with the last slide. So I hope Colm and I were able to kind of share with you why we're passionate about this business and why we see value in enterprise trust. In the first instance is actually value in the whole sector. It is trading at an anomalous discount. But enterprise trust itself, we're particularly proud of our risk-adjusted returns, as you saw in the slide, in terms of the low volatility and our ability to take risk out of the private equity portfolio, but at the same time, that portfolio growing and showing some significant uplifts in the embedded value. And with that, I'd like to conclude and open it up to questions.
Thanks very much to both of you for a very interesting presentation. We have a few questions already, but if you are listening to the broadcast, please do keep your questions coming in. We should have enough time to get through all of them. We had a question asking about something that I suppose we've been thinking about a lot more recently, which is the impact of interest rates on our investments. How would a portfolio like yours react in a rising interest rate environment? Specifically, what impact would it have on the valuations, the DCF models that you use?
That's a great question. So overall, when you look at the interest rates, how much risk does it create in our existing portfolio? As you know, private equity uses leverage quite intensively. However, all that leverage which is in the private equity portfolios is fixed and is covenant light, and so therefore interest rates do not have a direct impact on the existing portfolio. Where interest rates obviously, but in the future, higher interest rates would basically mean that the returns will come down for newer investments, as the top managers and the top tier managers would shift their portfolios into companies which are, let's say, continue to have very strong cash flow, but wouldn't take as much debt on. And so therefore you will have still a safe portfolio, but probably not growing as much as what you're seeing right now. But overall, the portfolio is in very good shape, and interest rates would not impact the existing portfolio too much, because as I said before, the leverage is the debt is held at fixed rates, which were in the past obviously quite low, as well as on covenant light. Just to give you an idea, the overall leverage in our top 30 companies is around just around 4 times. So it's not to where it was during the GFC crisis, where private equity portfolios were leveraged at 5.5 to 6.5 times. So we're significantly below the historical average. What it means in terms of portfolios, if you look at our industry sector exposure, is very much driven by healthcare, technology, business services, very little financials, very little oil or commodity or consumer sectors. So it's all mainly industries which can actually pass on inflation costs and are less impacted by interest rates. And so that is a portfolio which is pretty sound in terms of being able to pass on consumer cost or inflationary costs.
And just one final thing to add, just you mentioned about the impacts on our valuation models. One of the things, and it's no secret at the moment that market valuations are quite high, but when we make co-investments, there are more concentrated investments. We're very rigorous about stress testing them for lower exit multiples. So we certainly never assume any increases in valuation multiples. And we always assume, in fact, quite significant reductions in valuation models. So we stress test the resilience of the investment thesis to the kind of changes you've outlined, Thomas.
And so there was a related question on that. So could you just sort of outline a bit about how the mechanics of that valuations, and probably not in all the gory detail, but you highlighted the significant uplifts you achieved to the carrying value. So what are you roughly doing? These are comparisons to public companies, a multiple of sales. Roughly, how do you go about valuing companies?
Should I take this one, Oliver?
Yeah, go ahead.
As the lapsed accountant. So we prepare our valuations using the industry standard, which is the IPEV, so the International Private Equity Valuations Methodology, which very much focuses on market-based valuation methods. And for most of our companies, that's very simply looking at EBITDA multiples, because it reflects the way in which most market participants would value them. Our portfolio is a mixture of assets managed by ICG, where obviously the valuations are prepared in-house, and valuations by third-party managers. But in each case, we make sure that with the third-party managers, they also comply with the same standards. So it's very much based on comparing the company's usually last 12 months earnings, comparing them to listed comparable companies, similar business models, similar growth profiles, similar margins, and also looking at recent market-based transactions as well that have happened in the private markets. And we triangulate those valuations, and that's what generates the estimated unrealized value. But as Oliver pointed out, these valuations actually end up being quite conservative, because you saw from that previous slide, there's a very strong record of persistent uplifts when things are actually realized. And we think, as Oliver was saying, that's one of the key aspects of the current value proposition.
Yeah, now the question is, why is that, right? So why is that it is so conservatively held? And there's a fairly simple answer to that. It's all about alignment. It's all about alignment of interest with the investors. So if you are a top tier fund and you've had historically great track record, you are not worried about fundraising. You will get very easy your fund raised for in the next fund as a private equity fund. So therefore, your incentive is to keep actually the valuations very conservative and mark it up at realizations so that the investor has a good experience. And so therefore, that's what you see what's happening a lot. However, if you're a fourth quartile manager, if you're a very poor manager, the incentive is the other way around, because you're going to have a tough time probably raising your next fund, and therefore you have more. It's more likely that you're going to be aggressive on the value, on the fair market value estimation, in order to raise your next fund. So we have lots of experience in this industry. We've been around since 1981, and we've had 40-year experience. We have access to the top tier fund managers. And so we know who are the managers who are the top tier managers, and we get access to them, and they tend to be very conservative in their market valuation. So that's what you see in that slide I showed you, is the previous slide here. That's why you see these incredible uplifts at realization. And we also use the slide to actually demonstrate the quality of our portfolio and the quality of our top tier fund managers, because this is a typical indication that you have a portfolio with lots of top tier fund managers.
So you had a question asking, I mean, I guess you spoke about the growth of private equity investing and the size of the industry. Is that coming from the demand side, so money chasing opportunities, or is that because of some structure in the economy or in the corporate world, which means more companies are available? And so if the former, then are you chasing? You frequently competing with larger and larger pools of money. And then related to that, is there a danger with a fund like yours where you're buying out companies? Are you buying out failed businesses? Are these the sort of businesses that are on the market, so to speak?
Yeah, no, it's a very good question, and it's really both which drives it. So on the supply side, private equity has outperformed any other asset classes, and so therefore in a low yielding environment, people are looking for higher yield and higher returns, and are therefore looking in the alternative markets, and particularly private equity, perform better and have outperformed other asset classes, and therefore it's very attractive. And all the big pension funds, the very smart, sophisticated sovereign wealth funds and pension funds, are providing more capital for the private equity market. On the other side, there's also more demand to have your company being sponsored by a private equity investor, because you are inviting into your shareholders, into your shareholder base, typically industry experts who really know the industry well. They are often CEOs who have a lot of experience and have done and turn around or managed businesses before. and you don't have the pressure of quarterly earnings all the time, and you have therefore the patience, the right shareholder base, and capital to invest in your business to kind of make a good business a better business, and to have also capital to grow the business by consolidating other players in the industry. And that's what you're seeing, and that's why you're seeing also in the public markets more and more companies actually selling themselves to private equity, because they like that model better, because it just creates more shareholder value over a longer term.
A question here about, so the broader ICG business is, you've spoken about there being a discount for some period of time. Is there scope for you, someone is suggesting, well, if you have lots of clients in other pools of money, can't you push them towards the trust and close the discount? How does that relationship work?
Colm, do you want to take that? You're on mute.
Yeah, the mute on mute thing. Yeah, so the answer is that we do speak to other clients at ICG, and some of them have become shareholders in ICG Enterprise Trust. And we have made a lot of attempts, successful attempts, to broaden our shareholder base, and we're trying as well to spread the word a little bit more. We've dramatically increased our media exposure and broadened our communication channels. So, and as I say, speaking to ICG clients is very much part of that effort. But remember that ICG, is a huge alternative assets manager with a wide variety of strategies that are quite different to what we do. An example of that is we invest alongside ICG in 5 of its strategies, but that's out of a total pool of 23, 24 different strategies we could invest in. So there's there's different types of clients seeking different returns, different risk profiles as well.
And I think, Oliver, you referred to this idea that there's a sort of a memory of the financial crisis, perhaps, has led to these persistent discounts for some time. What do you think could cause a fundamental change? What do you think you see the sector as a whole trading closer to par in the future?
I think it needs the industry, as they are doing, is creating more awareness, and I think COVID, from that perspective, I think is a wonderful. It has been an event where we could very clearly show that the industry is in very sound and safe, and that we've been able to manage our NAVs very nicely, and the portfolios are in great shape, and everybody came out of the COVID scenario incredibly well. And I think that's a great data point, which we just need to, the investors have to analyze, see, and the industry and Colm and I need to create more awareness and educate the market that this is a very different looking industry than it was during the financial crisis, and that the survivors of the financial crisis know what they're doing, and they have been, and we've been doing this for 40 years, and we have a very sound and safe and sustainable investment strategy, as you see in here in the data, with low volatility. And that's what we just need to be spend more effort on, educating the market and creating awareness with our investors.
And the board has the ability to use buybacks, I believe. We have a question highlighting that the trust bought back shares in July, but none since. What was the strategy behind the use of buybacks?
The strategy behind buybacks is to make sure that in periods where we feel something is capping the share price, if it's some overhang of a shareholder who wants to move on, or if it's something anomalous happening in the market, then we're happy to do the buyback in order to defend the share price and making sure the share price trades as freely as it should be. I think, but more importantly, I think, is to expand our investor base and to have a more diversified investor base and a more liquid investor base, so that we can so therefore we are not we don't that share buybacks can be will only be used in order to kind of really work on these specific, it's very event specific. What we don't want to do is continue to use share buybacks whenever there's a certain discount, because that will just take liquidity out of the market and out of our shares. We don't want to. That's not something we want to encourage. We want to actually do the opposite. We want to create more liquidity and broaden our shareholder base.
Thanks very much, Oliver and Colm. Our time is sadly up, and thanks very much to the audience, particularly for those who put your questions through. I hope that's been interesting. Certainly was interesting to me, and I would flag that we are expecting some results coming up soon, so that will be, it could be an interesting thing to keep an eye on. Thanks to both presenters and to the audience. If you are able to stay with us, we will shortly be hearing from Brown Advisory US smaller companies, and we'd love to see you there. So thanks, Oliver. Thanks, Colm.
Thanks, Thomas. All the best.
Thanks, Thomas.
Thanks, everybody.
Thanks, everyone.